There's a reason why you have hundreds of billions of damages from climate lately, and over, say, a majority is not covered by insurance. And that reason stems from that lack of scale, from the delays, disputes, fraud, from all sorts of issues that come from relying on subjective loss assessment. And if you take a step back and think about what parametric insurance does, is it really equalizes the balance of power between an insured and an insurer. Now it's an objective trigger.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions: are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote? This episode is brought to you in part by Base Carbon. It's time to get serious on carbon. Learn more at basecarbon.com.
Welcome back to Carbon Frontiers 2024 on Smarter Markets. I'm Dave Greely, Chief Economist at Abex Technologies. Our guest today is Sid Jha, founder and CEO of Arbol. We'll be discussing his work building parametric insurance markets to help manage the risks created by a changing climate. Hello, Sid. Welcome to Smarter Markets.
Thank you for having me here, Dave. It's a pleasure.
Well, thanks for joining us today. I've been looking forward to the conversation. I know that at Arbol, you're working on helping people better understand and manage the risk they face from weather and climate change. And, as we got started, I was curious because I noticed that earlier in your career, you worked in both interest rates and commodities markets. And I find it an interesting progression. And I was curious, what got you interested in these problems? Was it your work in agricultural or commodities markets?
Yeah, so it honestly starts early on. I'm from India. I grew up there for part of my childhood. I'm from a very rural part there. So agriculture is very much in the lifeblood of my upbringing. I myself was, of course, not involved in it, but generations of my family have been. But when I came to the US and then went into my career, as you said, across interest rates and commodities is especially focused on weather risk. A vast array of commodities, as you might guess, from everything from corn, soybeans, to natural gas, to sugar, coffee, cocoa, all have extremely weather-dependent supply chains, extremely weather-dependent production and consumption patterns in different ways. And so keeping track of weather risk was essential in commodities. At the same time, there was very poor mechanisms to transfer that risk. If the purpose of markets is to help risk transfer, right? So a corn futures contract allows a farmer to say, hey, you take the price risk. I just want to fix the price I will get after harvest, right? That's a form of risk transfer. That's an extremely important part of functioning markets. It seemed odd to me that the transfer mechanism for one of the most important risks we face every single day, and that's not just in commodities, that's in your home insurance, that's in if you run a restaurant on a seaside town, the list goes on and on. You had very poor mechanisms to transfer that risk. You didn't have it as an asset class. It was a one-off transaction here, one-off transaction there, very bespoke, no real scale, but you didn't have an asset class. Like corn futures are an asset class. You have equities as an asset class of different sizes and gradations. Weather risk or climate risk was not really a well-built asset class. It had the beginnings of one in some parts, like cat bonds, but it needed a lot more development, a lot more sourcing of that risk. And so, it was a natural progression in the sense that interest rates teaches you a lot about how financial markets work. Commodities teaches you a lot about how the physical world works, especially as it interacts with our daily lives. And to get this weather market going, to get the weather risk, climate risk as an asset class, you need both. You need to understand the risks, physical risks facing the client, but you need to get them capital. You need to get new forms of capital to write those risks. And it needs to be more diverse than the small group of reinsurers used to focus on it. So that's where interest rates in a broad sense, like understanding how the financial pipelines work, is very important.
And I wanted to ask you, in terms of how you're helping people manage those weather and climate risks. I know at Arbol, you're providing, what's called parametric insurance as a product to help people manage that risk. Can you explain for our audience who may not be familiar what parametric risk insurance is and its benefits compared to other more traditional forms of insurance that they might be familiar with?
So parametric insurance is a form of, you could think of it as a financial product that references data as a trigger. So in more simple terms, when you have an insurance policy, and let's say your house gets flooded, somebody comes to your house, an adjuster, and determines what the loss is. Same thing in a farm. Drought happens. Insurance adjuster comes to your farm and says, hey, your production dropped by this much this year. That's what I assess. Parametric insurance determines that payment based on a data trigger. So in, for example, the farm case, if we could say, if rainfall is less than a certain number of inches in the month of July, I'll make you a payout because that likely means drought. We can get more direct and say, hey, I'm looking at your farm, extremely granular farm area by a satellite, and I'm assessing that the crop is pretty much gone. Here's a payout based on that data set. But it's really about using an objective trigger, an objective external data set that both parties, the insured and the insurer, agree on to make that payout. And so, and it doesn't have to be an insurance form. There's derivatives, there's reinsurance. They all are the same thing. Here's my data set, and here's a trigger or a set of triggers. It can get very complex. It can be very simple. That determines how much I will pay you out. Maybe I pay you $100,000 for every inch that the rainfall is less than average. Maybe I pay you $1 million regardless of whether it's 1 inch below or 5 inches below. We can do all sorts of combinations of that. And that depends on your risk profile. That depends on that. But that's the overarching premise. And if you take a step back and think about what parametric insurance does, is it really equalizes the balance of power between an insured and an insurer. Now it's an objective trigger. Now it's a 2-page contract, not a 700-page contract. Now it makes it easy for both parties to agree on what the payout should be, rather than the traditional insurance case where the insurer has quite a bit of power to determine your loss amount. Not to mention how long it might take, especially after a big event like a hurricane or a big drought. It might take a while for a specialized adjuster to show up at your place. So that's a scale problem. And then there's the disputes that happen, litigation that can last years in many cases. COVID spawned, 20,000 plus lawsuits about whether a pandemic is covered. You don't have these issues with parametric. And on the other side, there's obviously fraud that can happen on the insured side. So there's a plethora of issues with insurance, and this is the reason why it's not just an intellectual problem. There's a reason why you have hundreds of billions of damages from climate lately, and over, say, a majority is not covered by insurance. And that reason stems from that lack of scale, from the delays, disputes, fraud, from all sorts of issues that come from relying on subjective loss assessment. And it's not scalable outside the few areas that insurance has built a 100-year-old supply chain, basically.
Right. And in terms of the types of events that can be covered, I think often when people think of climate risk, their mind turn to the catastrophes, hurricanes, droughts, wildfires, floods. As you said, this is part of the types of events that you can provide insurance against, but you see parametric insurance as broader than that, right?
Much broader. So one of the issues when we started was that there was a very limited scope for parametric in the minds of reinsurers and insurance industry when we started, right? So what would happen is that it was mostly considered a nice, almost like a corporate social responsibility product for some farmers in emerging markets. And it was a very limiting use case in my mind, an important one, but actually a very limiting one. Where parametrics start to really shine actually are those non-localized damages at times, or regional damages. So what I mean by that is insurance is very focused on the local, right? So something happens to my home, a hurricane goes near my house, my roof is damaged, I call my insurance company and I need to get a payment to replace the roof. Insurance can handle that, though even that's becoming difficult right? Taking longer and longer. And all sorts of social costs came in. Where insurance is unable to even muster a product is, and I'll give you some examples here to make it a lot more concrete. Let's say you're importing semiconductor chips from Taiwan and you're in Europe and there's a drought in Taiwan and they can't produce enough. You were counting on those. What's the loss there? And how do you insure against that? How do you protect yourself? You could be in the auto parts supply chain business, and you're in the US and you need to import, and Thailand's a big producer of these things. And there was a big flood, and now you can't get auto parts. Now there's a cascading effect, not just on you, but on your customers. And I'm citing real examples here. These we haven't yet done, but these are problems. We are kind of marching towards this whole path of clients starting to understand these bigger global risks. Climate is not a local risk, it's a global risk. But the stuff we do is, for example, let's say you are you're providing electricity or heating in Europe and you import liquefied natural gas. What price you pay for that, unless you're on a fixed contract, which increasingly you're not, what price you pay for that depends on how cold it was in Asia, right? How much did they need and how much will they pull? So this kind of mindset of supply chain is not insurance is not designed for this. Like you won't be sending an adjuster to fly from London to Tokyo to figure out what the temperature there is. It doesn't make any sense. Or to figure out how much water is in Taiwanese reservoirs for TSMC to make chips, right? So it's not it doesn't make sense from a logical standpoint. Another arena where parametrics has a huge use case is the financial arena. So one is, and this is a very large and growing business for us, is that insurers themselves are struggling with climate risk and they need reinsurance. Most insurers heavily rely on reinsurance. They don't retain most of that risk. The risk that they can find reinsurance relatively easily for are remote risks, right? You have 1 in 25, 1 in 50 year, like the Hurricane Andrew risk going through Florida or something like that. Where they have a lot of difficulty is more frequent risks, the 1 in 3 year storms, the tropical storms that might come 1 in 5 years. Because for the insurance industry, the frequency of the claim matters a lot. Every claim could mushroom all sorts of other costs, including litigation, including replacement cost inflation, lots of these issues. That's not a great risk for the reinsurers. But if you can make it parametric, you can get really close to indemnity. You can use hurricane tracks. You can use very granular wind speeds and all these other things to create a product. Now you pay just based on data. You're not paying on indemnity, but you are transferring a large portion of the risk from the insurer to the reinsurer, or actually more likely a non-reinsurer, an alternative capital provider, maybe from Wall Street, maybe a pension fund, whoever it is who's looking for uncorrelated risk. So now you have increase the pool of capital that can enter into these markets. And you are able to transfer risks that were not transferable. And the consequence of not being able to transfer that risk is that you have insurers leaving large parts of the country. Okay, there's too many tropical storms in this area near the coast. I can't write insurance here. There's too many wildfires. I'm abandoning this part of California. This is happening all across the board. And when they are there, the cost is just rising astronomically. I was just talking to somebody yesterday who was like, okay, it was in a beach town and they have a summer house there. And it's like every year, the home insurance cost just keeps going up without any losses. It's almost as, and this was a quote from them, that this is almost as if they want me to not buy the coverage. And it's true. It's kind of like the passive aggressive way of like reducing your footprint. But it's happening all over the country. And in some parts of the country, your home insurance cost now exceeds the mortgage. Crazy.
Yeah, I think most people have really experienced that.
Yeah. And so parametrics offer a very interesting solution where the insurers can now tap into more capital pools to transfer out risk. If the insurer can reduce their risk, they can stay in an area. On the other side, a traditional policy could over time benefit from bolt-on parametrics for the consumer. Here's a bolt-on policy that pays you if a Cat 3 above hurricane gets within 10 miles of your house. Okay, does it mean that there might be basis risk there? Sure. But it's a way for them to get paid quickly so they can start recovering, because most likely there will be some losses if something like that happens, right? creating simple policies for the consumer. So you have a lot of options to grow there. The final thing I will say about the scope of parametrics, which is very much not appreciated fully, is that the banking system and the sort of asset manager system, I consider them similar financial systems, are going to start struggling, if not buckling under climate risk. The central banks are already stress testing banks. That's the first step. Imagine if you're a regional bank and you get stress tested by the Fed, and now you have to go raise equity capital because you have 1 million farm loans that are exposed to drought risk. How do you transfer that risk out? You can't purchase drought insurance for each contract and have any hope of getting paid quickly after a drought, because who's going to adjust, who's going to do traditional adjustment, who's going to do subjective loss assessment on such a large portfolio? Well, Parametrics offers a great way to have, rainfall-based or drought-based triggers on your bank loan portfolio and find capital market access to transfer out that risk. This is the part of Parametrics that I don't see much discussion of yet, because we've been working at it for a little while. We're starting to see that it takes time to get the clients on board, but the scope of Parametrics is in the trillions. Now, when we started in 2018, it was like, well, can you even get $5,000 of premium done? And it was a very different conversation back then. But I think things are really changing on that front.
Well, and I find these various use cases really thought-provoking. I wanted to ask you a little bit more about your customers, but I'm just thinking through some of the things you've said. I found it really interesting that some of the early use cases and customers were kind of in more developing countries, agricultural areas, where I imagine traditional insurance coverage just wasn't built out. So like the way to get it to where you didn't have the insurance supply chains and coverage that others would have. And then the reinsurance of traditional insurance industries sounds almost similar to like the reinsurance that banks could be doing with credit portfolios. I'm curious, are these the main customers so far? Or are there other customers, and are they being drawn from certain industries or geographic regions? Where are you getting them?
So, great question. So we have the bulk of our business is still US and Europe, though the vertical determines where we have gotten more traction initially. So our three big arenas are agriculture, energy, and reinsurance. And agriculture is bigger in the US, energy is a little bit bigger in Europe, but it's a little getting more balanced, the US catching up. And we have a rapidly growing East Asia, Australia type presence in energy as well.
And what is the energy in Europe? What's the use case there?
So the use cases are primarily around a couple of things. One is, for a utility, the biggest determinant of demand is temperature, right? Load, if you will. So what that means is, and we have seen horror stories of this, but what happens is in the summer, let's say, temperatures spike and suddenly, everyone's running their air conditioning. Now the pull on the grid is massive. And now your utility has to meet a lot of these obligations, but their power production is relatively inelastic, right? So it's a classic problem, right? You have elastic demand and inelastic supply. It's not like the utility can suddenly build a new power plant or get more coal or natural gas in or whatever to produce it, or make the sun shine anymore to get more solar. So you have inelastic supply, elastic demand. That creates a situation where now they have to procure power in the spot market, in the I call it live market if you're not in commodities. And how do they do that? Well, they have to go and buy it. Well, the problem is that when they're going to buy it, everyone else wants the same power, right? So when you have power is one of the most volatile markets in the world by far. I would say it's even more volatile than what even crypto markets and things like that people consider so volatile. Power markets are crazy, right? So you can have power prices that might normally be $30 and they're at $3,000. And now you're having to buy power at this astronomical price to meet your contract obligations and not black out customers, which is its own set of very problematic disasters, right? So you have an extreme dependence on temperature. In winter, it's on the other side, spikes in cold. When Texas had that freeze event, you had multiple utilities either near or actually going bankrupt because power prices went from 30 to like 9,000. So Power markets are increasingly dependent on temperature. They're also, increasingly affected by volatility in wind and solar. And that volatility actually affects everybody from the local asset owner in renewables all the way to the grid operators, right? So if West Texas suddenly gets a ton of wind, power prices dip negative. And then suddenly the wind stops blowing and the power price can climb back up. So can all happen in a matter of, minutes or hours. Similarly, we do, wind speed stuff in Germany, in UK, in different areas at different scales. That's the other flexibility of Parametric. I can write you coverage for a single wind farm. Or I can write you coverage for an entire state where every wind farm production is scaled up to the state level. So there's a lot of flexibility. And so what that flexibility does is you have different clients who will kind of work with you. So in energy, it's been temperature, but then we work a lot increasingly with the renewables, where we see a lot of growth opportunity. We basically have two major industries, wind and solar, that are growing rapidly, and their outputs are very dependent on weather. It's, for us, a great market. And, things like renewable energy credits, production tax credits, the production of these, how many renewable energy credits you produce is actually dependent on how steady the wind was. So if you have, and this happens a lot, you'll have a month where wind was really, really low and it throws off all your revenue things. And that causes cascading effects because now it raises your cost of capital as well. You were counting on that revenue, you have borrowings. So there's a whole ecosystem here that we're working on. In agriculture, it's been mostly the processors, right? So we're working with, and it's all different sizes, but you might have somebody who processes cotton to create yarn, gin. If there's no cotton in your local area, that's going to be a serious problem for you. But you're not going to get the federal crop insurance subsidy when that crop fails, right? That's for the farmer. So you're left in the lurch. You have extreme supply chain risk to crop output. Similarly, if you're a seed, fertilizer producer, or you're on the processing, warehousing, basically you have all these supply chains that depend on, hey, did the crop actually happen, right? So what we found was, and going back to the emerging markets agriculture case, even from a personal standpoint, I feel like that needs to grow significantly. But it's a huge challenge because who's going to pay for it? It's a tough thing. How do you figure out who's going to pay? Because the premiums that a farmer can afford versus the premiums that are fair economically, unfortunately, still have a large gap in a lot of emerging markets. We'll get there, and we have done some small programs through blending it with lending and some other aspects. Like I lend you some money and part of the loan interest rate is a premium. But it's tough to scale these programs.
And I wanted to ask you a little bit about how do people get a sense of, what's the fair value of the insurance versus, what's the premium being priced in for the risk? And I'm curious, how do you and your customers come to understand and price the risks posed by climate? Not to get too quantity, but how do you quantify the range or likelihood of possible outcomes, particularly in a world where the climate's changing and historical statistics might not be representative of outcomes in the future?
Always a challenge. And this is where having background in trading helps, because that's the case in almost every market. It's funny, I get asked like, oh, my, climate's getting more volatile. How do you handle that? And it's like, well, I also traded oil futures during the Arab Spring. I traded wheat when, southern Russia was on fire, basically, and it was a mega drought. And I mean, the list goes on and on. So once you get used to markets, you basically have a hurricane all the time. Somewhere something is going on. And I used to trade across the whole complex. So somewhere something was going wrong almost all the time. And past patterns, I would argue that when you write risk on climate, yes, past patterns don't lend themselves to the future, but that problem is actually significantly worse in financial markets. So you start to learn to build the quantitative tools, how to understand what the uncertainty bands are. And this is another kind of misconception that comes up is like, I'm not trying to predict the weather. That's a fool's errand, right? We're writing risk like 3 months out, 6 months out. Like, okay, you want coverage for next winter being warm. I don't have any sense for whether it'll be warm or cold beyond maybe 1 or 2% chance. How do I address that? Well, yes, I could do some understanding of the trends and what might be happening. And a big part of the work is putting the uncertainty band around it, right? The distribution. So, okay, maybe my distribution says that it's a slightly higher chance than 50% of being warmer. We've been seeing that in recent years, of course. It doesn't take a rocket scientist, but we can get a lot more precise there through the use of climate science and, actually a lot of AI now. AI is great for that horizon because physics breaks down. But AI is great at incorporating humongous amounts of information. And if you can infuse it with an understanding of the system, right? It goes wrong when it's just garbage in, garbage out, because you just threw a bunch of numbers at it and thought you'll get results. So having understanding of climate science helps for it to infer patterns. But you might infer a pattern that, okay, it's probably a 51% chance. Now, that's almost a step one. The bigger issue here, or the bigger defense you have, is diversification. So I know that I'm going to be wrong at least 49% of the time in my example here. In fact, I'm probably going to be wrong possibly more than that, just because its climate is so random. So what I could do is make sure that being wrong doesn't take me down. So limit concentration, raise prices dynamically. And that's a big part of our automated, what we call our AI underwriter, is how do we raise prices if it gets concentrated. If 49 people ask me for drought coverage in Texas, what do we charge the 50th guy? You can do it qualitatively, but a lot more precise, quantitatively, by understanding how it's affecting not just the average of your distribution, but all the pieces of your distribution. Thinking of a distribution in its entirety. And, that's sort of how we try to manage climate risks, is really just sourcing different types. And they're all very varied, and they all don't go in the direction of climate change, right? Going back to my earlier example, when it gets super cold, utilities have demand stress. That's not in the direction of climate change, but it is a big loss they will suffer if it is a very cold event. So maybe that's a type of risk that I'd like, because I can also source warm risk pretty easily. So trying to balance distribution and thinking of distribution as this very fluid, dynamic concept than how it is thought of in a more standardized insurance format, which is, okay, here's the brokers I talk to, here's my channel, and that's the distribution I'm getting. For us, distribution is more like, where's the next source of diversification? Is it farmers in Poland? Is it solar panel in Brazil? Where am I looking for the new type of climate risk to source? And it's great if they become regular clients, but we want these regular sources of diversified climate exposure.
Yeah, and I wanted to ask you, this diversification is so important to deal with that risk, and there's ways you can source that. And then what remains, as you said, the risk needs to be transferred. And I was curious, there's a good understanding, I think, now of why customers would want to be able to lay the risk off. Who are you finding who has an appetite to take the other side of the trade to kind of provide that insurance that your customers are looking for?
Yeah, so this was the other part of the puzzle, right? What has helped us scale. When we were starting out, there was a number of other startups who were attempting similar things in different ways. And what a lot of them were doing were following that insurance model. So we're going to be the best in hurricanes, we're going to be the best in earthquakes, whatever it is. One product, and we're going to have a reinsurer backing us, one of the big ones, most likely. And when I looked at the way, and we actually used that in our first year, it was like we had a little agricultural platform and we would shop it around to the best price we could get for our customers. And so what we actually found was that, the customer expresses interest. One deal is too small for these guys, so we would have to wait till we aggregated. And so then we had to almost start to understand how these guys are pricing. What margins are they baking in? We can all agree on historical numbers, but their margins varied a lot more. What we found was the pricing was erratic, very difficult to rely on. And sometimes the capacity would just vanish because we had a loss in this completely unrelated division, but now we are pulling back on rainfall risk because I don't know. It's a black box. I have no idea. So we realized we couldn't build a business like that. And the key was, and it all now sounds like, well, this was also like all known day one. I had no idea what I was doing for a large part of the beginning of Arbol, right? So it was like these ideas took time to coalesce, and it was very important to have the very experienced team I have around me, much greater experience than myself. But the key insight that really cracked open the thing was that parametric products are great for the consumer, but they are actually fantastic for capital, alternate capital. Reinsurers, we would take time to convince. These guys are very slow. They take their time, and they have reasons for that. There's also very many regulatory issues and many other things. Wall Street capital, alternative capital, I would just call it alternative. It's a plethora of different kinds of funds and others who participate in financial markets. These guys are much more nimble. They're used to moving fast when they see the opportunity, but you have to frame the opportunity in a different way than you can with a reinsurer. And so being able to speak that language was important. But what was equally important was the fact that parametric products settle very similarly to products they're familiar with, right? You're used to trading corn futures, you're used to trading equities. There's a price. It settles on that. You know your profit and loss at a certain point very quickly.
Yeah, in certain respects, parametric insurance sounds similar to weather derivatives in Wall Street speak, I guess.
Yeah, they are risk equivalent, right? So if I tell you that I'll pay you 100,000 for every degree that the average temperature in July is less than average, that could be a weather derivative or it could be an insurance contract. There are legal and tax and many other reasons why you would have one or the other. It's why we do all these different forms: derivatives, insurance, reinsurance. You can take all those risks, right? What's reinsurance? It's just doing the same thing, but on a larger portfolio because an insurer has collected a bunch of these risks. But the risk might be the same. If you look at the underlying risk, it's equivalent of whether derivative or parametric insurance, whatever. So if you are an entity that's used to transacting in futures and options markets, well, this resembles that almost exactly. I just have changed the underlying from corn price to rainfall or temperature, right? So as long as you can get comfortable with the data set and how it might behave, you have a bridge now to a whole world of capital that others who have a more insurance background may not have access to. Being an outsider was helpful here because to say I knew nothing of insurance was an understatement when I started. I literally had never worked in insurance. I had no idea what insurance beyond the Investopedia definition was, how that industry worked at all. So when you can understand that, then you start to see, okay, this is the bridge, but then what's the hook? Why this versus the markets they're doing? The other side of what you realize being at hedge funds and trade houses and all the other things is it's so hard to find uncorrelated markets, so hard to find uncorrelated ideas lately. You look at the top few equity hedge funds, the large ones, most of them are the same 10 stocks that we all know. If you just bought Apple or Nvidia and you run an equity hedge fund, are you really adding value? I mean, I could just buy those directly. Sure, you might have a little extra value based on your research and all this stuff, but I'm also paying exorbitant fees to access these markets. I'm paying 2% of management fee, I'm paying 20% of profits, or I can just go on Schwab and buy it for almost free. So the question is, how do you add value when you're a trading entity or when you're a fund managing entity? Well, you got to find new markets that are uncorrelated. You got to find new avenues to source alpha. And this is true alpha because, the temperature in London or rainfall in West Texas does not care whether, the Fed is hiking or lowering interest rates or whether there's geopolitical trouble going on in Eastern Europe. It's just a very different asset class. And especially because we are focusing on seasonal transactions, you're not locking up money for years and years, 5 months, 1 month sometimes. You just know what your profit is and you move on. You can cycle that capital again. So it became a product that is highly suitable for alternative capital. Not all types are. The more remote your risk gets, the more tailish it gets, it's less suitable because then a lot of these guys don't have credit rating. They have to put up full collateral. Your risk is $100. You got to put up the $100 fully and lock it up because that's how the other side will trust you. Well, then if you're making $2 in premium, that's terrible because you could have just put that in a treasury bond and gotten more. with taking no risk. So there's nuances to this. It's not as straightforward, but there are parts of this parametric insurance world that were very, very underserved, undercapitalized, and opening that door to Wall Street was very, very important.
Something very important bridge. I want to come back to the piece you brought up about data, but I wanted to switch gears for a second. So I wanted to ask you about another use case. We've been talking a lot about customers looking to protect themselves from weather and climate risk. And then, of course, you've got lots of people out there working with carbon reduction or removal projects to try to lessen the climate risk that we'll face in the future. And I'm curious, what sort of uses do you see from carbon reduction and removal projects for this type of insurance? I know you mentioned potential use in solar or wind installations. I imagine there's uses for, if you're trying to preserve forest or grow forest, prevention from wildfires. But I'm curious, how much appetite are you seeing from that industry?
It's a focus for us. We built a lot of analytics around it. And as you mentioned, the two arenas where I especially see use cases in renewable energy credits, where their production itself is dependent on these variables. So you could imagine packaging a REC with this insurance, and now the value has gone up because the buyer now gets a better line of sight into how many RECs they can procure, right? So there's a benefit there. Forestry is very important. We have a lot of internal analytics on understanding deforestation and basically via a mix of satellite and AI methods getting to see very granular levels of deforestation. Is that ready for prime time on an insurance level? I think it's getting closer. I think the clients are starting to realize there's a need for it. You've had obviously major problems like I think one of Microsoft's forests burnt down, and there's a lot of risk there on the carbon credit side if that happens on these nature-based assets. And because a lot of these nature-based assets are in very remote areas, could be the Amazon, could be West Africa, wherever, you have actually a lot of scope for parametric to grow. I think how we approach all these problems is before we even get to an insurance product, we have to ask, how good's the data, right? And how good is our forecasting model? So now we're able to build 20 plus years of history on a forest based on a stitching of different satellite info. And we can measure like biomass, which is essentially the weight of the forest, right? And you could imagine a parametric product that is struck on that. We have the tools ready for it. Now it's a matter of lining up buyers and capacity. And the buyer side is where I think education is being worked on. But it's been interesting to see major insurance brokers be very interested in this, and we've been having discussions on this front.
Yeah, it seems like this is such a highly customizable type of insurance product. And one of the limiting factors really seems to be the data. I was just curious, how do you go about getting the amount and the right type of data that you need? Is that a big challenge?
It is, because there's no one set of data, right? So it's different satellites covering different parts of the Earth. There's also different types of, and I'm just going to go into the forestry for a second to show you the level of complexity that comes about. So you have optical bands, which are basically kind of like your iPhone camera, but in space. There's different resolutions that might cover different parts of the planet and in history. You have radar satellites that can pierce through clouds, and they basically shoot a microwave beam and see how the bounce back looks like, which can tell you, okay, what's the state of the forest in a different way. It's especially necessary if you're in the tropics, where cloud cover is a major problem and it's not as easy on the optical side. Within radar, actually, there's many kinds of bands. Because the radio frequency bands, depending on their wavelength, they are good for different applications. So certain bands are good to understand leaf canopy. Others can pierce through leaf canopy and understand the lower surfaces of a forest. So now you have hundreds of different bands you're considering, because even in the optical, it's not that simple. You can break that down into anywhere from infrared almost up to ultraviolet, right? Different colorations, it just goes on and on. All these satellites have different paths. So your part of the forest may have a pass-through going from radar at one point, but then optical at a different point. That all has to be merged and blended. And so luckily, there's people far more talented at this than I would ever be to kind of handle this aspect. And then once you have all of this nicely organized, that's when almost the real work starts, which is, okay, how do we build some sort of AI model to understand this, understand what's going on in the forest based on realized data that we might have from different aspects? That it's a challenging problem, and to get the thing right. And you may not get it right for every type of forest. You probably won't. You might be getting it very accurate for a certain type of forest, but other types of forest might be really difficult. So there's a lot of these challenges, but once you can kind of sift through them and say, okay, I can at least start to build a nice history of forest health. Now you can begin to even think about how you underwrite a product like this and how you determine payouts.
Well, first of all, I want to thank you for coming in today and sharing everything you're doing in parametric insurance and helping us understand how these markets work a little bit better. Before I let you go, though, I want to come back to something you mentioned about new markets and scaling and, the need to kind of have client education being a piece of that. And you began your career, as we noted earlier, in interest rate markets by some of the most liquid markets in the world. And over time, you've been progressively moving to newer and less liquid markets. And I'm curious, as someone who's spent their career managing risk and thinking about risk, maybe you could share, what have you learned about managing risk in these newer and less liquid markets that you think others need to better understand and to understand better if we're going to make these markets work?
Great question. Illiquid markets teach you a lot about being precise, detailed, thorough in a way that I think there's a certain comfort in liquid markets that, okay, if I was wrong, at least I can get out. Doesn't mean you want to be wrong, doesn't mean you want to be imprecise. And there's a richness to those markets because you have a lot of data. In illiquid markets, you often don't have any real transaction data. You only have ancillary data sets that you can use to build a picture. So you get very good at taking sparse amounts of information and kind of building a picture of what price might do or where this market might go, which in a liquid market is a very different thing. You have actually there, it's noise filtering that's a big part of the work. When you're interest rates, you are getting bombarded by research and Bloomberg and CNBC, and all day people are expressing their opinions about it. Nobody's expressing an opinion about, hurricane reinsurance, lower loss cover in general, right? So it's a very different thing. Here, you're scrounging for information and building a picture of it. So it's that adjustment is very important, is how to deal with sparse information. And then really focusing on the best you can do is, here's my band of outcomes and here's their probabilities. You cannot get much better than that. You're just going to have to work with that. And so the corollary to this is that in an illiquid market, you really, really need diversification to, be able to handle the ups and downs that will come from the fact that you're stuck with this position. You're not getting out till expiration, right? You wrote this contract, it's with you. So make sure that contract is not the only thing you've written. Make sure you find something unrelated or opposing or whatever you can. So origination in an illiquid market, origination is key. Do you have a moat in distribution? Are you seeing stuff that others are not seeing? Can you build new lines of distribution? And this is where insurance is very challenging, because insurance industry is very old school, very well laid out paths of distribution. And so going around that is very, very tough. But that's what's needed to grow these markets.
Well, thank you for that. And before you go, I just wanted to say congratulations. I understand you just completed another financing round at Arbol. And I was wondering if you just kind of close out our conversation by telling us what you're working on next. What's next for Arbol?
For sure. So we just announced our $60 million Series B round. We have two new investors join as co-leads, Giant VC out of London, who have been great partners for us for a while, and Tech Ventures, which is the other co-lead. And we are looking forward to working with these investors and our existing ones to grow bigger in arenas like property insurance, arenas where we feel climate risk is really starting to have a major effect on the consumer, and bringing all our tools to bear, whether it is advanced analytics, advanced understanding of localized climate effects, to parametric reinsurance, and many of these other products we've been working on for a while, bringing all of that together into the new phase of Arbol, while continuing to obviously organically grow our agriculture and energy businesses, where we feel we have just scratched the surface and there's a lot more to go there.
Thanks again to Sid Jha, founder and CEO of Arbol. We hope you enjoyed the episode. We'll be back next week with another episode of Carbon Frontiers 2024. We hope you'll join us.
This episode is presented by Base Carbon, a financier of projects involved primarily in the global voluntary carbon markets. Base Carbon endeavors to be the preferred carbon project partner in providing capital and management resources to carbon removal and abatement projects globally, and where appropriate, will utilize technologies within the evolving environmental industries to enhance efficiencies, commercial credibility, and trading transparency. For more information, visit basecarbon.com. Base Carbon, sensible carbon investing. That concludes this week's episode of Smarter Markets by Abax. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment purposes only. The information presented on Smarter Markets should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Smarter Markets are those of the participants and do not necessarily reflect those of the show's hosts or producer. Smarter Markets, its hosts, guests, employees, and producer, Abax Technologies, shall not be held liable for losses resulting from investment decisions based on informational viewpoints presented on Smarter Markets. Thank you for listening, and please join us again next week.